I'm not coming from the perspective of Rocket Lab's gone sky high. I'm a genius. I cannot be beaten. I'm the greatest investor in the world, because that is going to crush you when the market gives you a slap around the face, which it will at some point.
Actually, in the end, take advantage of the situation by knowing whether it's time or when it's time to add more or whatever the case may be.
My plan is to go to cash ahead of a correction and pounce on discounted prices. Like, if investing was that easy, none of us would ever suffer drawdowns.
How excited am I about this company in this moment, and just get that intuitive feel and just see where to start potentially cutting or nibbling.
For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Welcome to Deep Investing Jungle with your hosts, Luke the Badger Hallard and Krzysztof the Monkey Piekarski. On this week's episode, stop chipping, I'm trying to introduce the episode, you damn monkey. The dangers of investing hubris and thinking you're smarter than the pack. Krzysztof, you've got a new Wall Street Wildlife bet for me. You're making me an indecent proposal. We're also going to analyze a Patreon's investment portfolio, but this is not investment advice. Plus, I'm finally actually go on Stock Safari with my private investment into Whoop, the activity tracker that's becoming a medical device manufacturer. We talked about OpenDoor last week. This week, Krzysztof's got an update for us. Two pros are going at it while he watches his banana stock grow. Plus, Krzysztof is taking us on Stock Safari with White Fiber, the AI power compute tidal wave stock.
Badge. So on Patreon this week, we sent out a post saying, hey, over on the YouTubes, we're like yay close, like 100 something watch hours away from starting to get some cash dollars sent our way from the Googles, and we want all the cash dollars. We want all those bananas. So if you're listening to this on podcast, thank you. But also, I found that because we use charts and we use figures that add to the investment case that we make, often from FinChat dot AI, that watching us isn't just a stunningly excellent aesthetic experience. It's also, good to see exactly what we're talking about. And every time I wanted to watch a podcast while driving, I've learned to queue up the YouTube, and sort of play it on the YouTube so I could every so often glance at the chart while keeping my eyes straight on the road. But also, my Tesla drives itself, so But anyway, watch us on YouTube's.
Yeah, like if you're walking in the streets of Austin and you get mown over by Chris because he's too busy watching like the All In pod on YouTube, it's Chamath's fault, clearly.
Way to ruin my excellently calculated sales pitch to get us our first 37 cents from
Yeah, this is quite an exciting point on the YouTube, though. You're right. We're about to start getting paid by YouTube, and that will allow us to, along with all the excellent patronage we get from our fabulous family of Patreons, invest in the show. At some point, we're going to buy Krzysztof a new mic, and a webcam, even though he's like railing against having more technology in his office. And there's a bunch of other stuff we want to invest in to make the show better quality for all of you guys.
Indeed, Badge. All right, so let's get to business.
Before we get to our roster of stuff I introduced, I just saw a tweet from the Donald just 2 hours ago, I think, or someone's reposted it from Truth Social. Just want to get your hot take on this idea, hot off the press. Donald says, subject to SEC approval, companies should no longer be forced to report on a quarterly basis, but rather a 6-monthly basis. This will save money, allow managers to focus on properly running their companies, blah, 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 something about China. What do you think about that? No more quarterly reporting.
Okay, so this is the first time I'm hearing this. Honestly, it strikes me as good. And this is why, because the short-term game is based predominantly on what's going to happen in the next 3 months. And some companies, most companies, take years to execute, but sometimes they're also forced into positions to not necessarily financially manipulate, but to set certain targets that will satisfy Wall Street, which is the short term thing. And that comes at a great cost for potentially the bigger vision. And it certainly messes with investors. So it kind of uh, places the weight more squarely on the momentum slash trading side. If I just take this statement holistically and I think, okay, I've invested in the company in the long term way for like as it with an investor mindset, and I get 2 updates a year on how they're doing, that seems to be ought to be enough. I mean, that's obviously subjective, right? But if as long as the company also sometimes gets to announce some big, whatever big thing happened, I imagine that would be part of this, right? Like any big news gets announced, you don't have to wait 6 months to announce something. Then this seems to me sort of shockingly anti Donald Trump because he's of the more right the kind of I would say shady side of things. So this is sort of surprising and good. What do you think?
Yeah, I think also I agree. Also think it's good. I don't know if it's like that out of character. Like he is about deregulation and making it easier for business, and this like fits that mold. I think interestingly, it's kind of following what Europe and the UK did a while ago. I might have my timelines wrong on this. I think back in 2014, something like that, the UK went from mandatory quarterly reporting to annual reporting, um, because it was about like the stuff you said, like preventing companies from being forced to focus on the short term. They can take like a bigger picture view. Plus, like cutting a load of costs and administration. It must cost like millions of dollars for a big company to just like get the auditors in. Well, they do that annually, but put together the materials, have their CFO spend like a ton of time having to like corral numbers from across the organization. Like focus on actually growing the business. Don't focus on giving me like stuff where you're just saying like everything is on track. And as you say, right, it's not like they're banned from reporting. They could continue to report as frequent as they wanted. Like but it becomes optional. They're just held to account. They must report every 6 months. In the UK, it's once a year. Um, and if there are material events, like there's different regulations around that. Like if someone acquires, a huge amount of stock or some other sort of regulatory action happens, they have to report those anyway. This is just one of the things they do. They could just ease some of the administrative pressure. So yeah, I'm a fan too. It's a good idea.
Yeah, and you know what? I don't know if you ever found this funny or odd. Some companies already sort of push back against the Wall Street game by saying we're not going to offer guidance,
Yeah,
which sometimes could be for bad reasons. But sometimes, if the company is fundamentally sound, they're sort of signaling, we're not going to jump through your arbitrary hoops, analysts. You do the work. We're going to build the company. And others, play by the rules and say you get this report and you get guidance. And so it's an industry, right? It's an industry thing. The analysts feed off of like the money has to come from somewhere. But all in all, this is a surprising proposition, and I think overall good for long-term investors. It would
yeah,
certainly make our lives less crazy by needing to listen to, we have half the number of earnings calls to keep up with. So that would be mwah.
I agree. And I think it should lead to better results because you just take some of the bureaucracy away, frankly. Bureaucracy is not good. And focus on, like, if my CEO wants to then go on more podcasts because he's doing less earnings calls, great. And I get my updates that way.
Yeah, bureaucracy bad.
Yeah.
We should
So,
make a short out of that.
yeah, definitely.
Bureaucracy bad.
Totally. That's my, like, when I left, like, the corporate world, it was because of just the mountain of bureaucracy and bullshit that that like the world I lived in, and I went out of my way to try and like bust the bureaucracy, but in a giant global machine like HSBC, it's just impossible.
You know what's fascinating about this as a lifetime educator? the academic world also has its share. Please don't get me wrong. In many ways, it's also toxic. But I myself mostly have gone just done my own thing in the classroom. You know what I mean? You know where my greatest source of bureaucratic hell comes from?
Me, because I'll give
You,
this shit.
exactly.
Yeah.
Exactly. Exactly. You took all your learnings from the corporate world and you put it on poor monkey's shoulders.
I know. Like I was going on vacation once, and I gave Krzysztof this like 50-line spreadsheet of all the tasks that need to be done just to keep this machine of the podcast doing its shit every week.
And how many of them were done? I'm afraid. Is it? Don't tell me I got zero things accomplished.
Yeah, no,
All
you're
right.
right. You're right. No, but do hold me to account on that shit, because actually there's a bunch of stuff that like it's probably I'm going too far and I'm creating like admin for admin's sake. So yeah, like shut me down if I say something dumb.
All right. So the market is flying right now, near all-time highs. And this week, I believe on Wednesday, the percentage on Polygraph or whatever of expected rate cuts, I think is close to 100% at this point.
Yep.
And people are now, in what I'm hearing, starting to chatter whether it's going to be a quarter or a full 50 basis points cut. Uh, but that's neither here nor there. We'll find out on Wednesday. It might be a volatile trading period. What we want to talk about is that, as always happens in the market, things come in cycles. And now, grandma and grandma's quilting friends are all asking about this investing thing. Of course, when things are at the peak. So we already know that this will not end terribly well for those who are sort of riding the hype, right? That aren't doing the investing properly. So we want to somehow frame this as a not just a warning, but we're picking up stuff about greed and hubris in these kinds of moments, and we want to walk you through maybe a better way to think about this. So, Badge, take us to what you observed and what you want to say about it.
Yeah, and I suppose maybe to intro this, like I'm seeing some sentiment in a couple of the investing communities that I kind of lurk around in. And actually, frankly, it reminds me of myself back in 2020, 2021. And I learned a hard lesson. And so I suppose, yeah, like it's one of our laws of the jungle. Thinking you're smarter than the pack is dangerous. And I'm not picking on this guy or girl, but I'm picking just one narrative. But there are many. I've seen like a lot of people who think they think they're like investing geniuses. Like right now, it's very hard if you're like an investor and if you're like pretty much like a long investor as opposed to taking like weird derivatives and short positions. If you're kind of long only, it's kind of hard not to make money, right? Everything is going up. And the quality and the great stuff is going up, and the dumb shit is going up. Everything is going up. And so I'm just going to pick on this one particular character, but like I'm seeing this in a lot of places. So this individual started managing their own investments in January 2024. I think probably I get the impression from reading some of their posts in this community, like they've been an investor for a long time, but kind of ETFs and indexes. So coming up for about a year and 3/4, 2 years, where we'll say he is like now hands-on and picking his own stocks with some proportion of his portfolio, and he's on track for 100% gain over 2 years, which is great. Like that's like everything's going up, everybody's doing well, but 100% gain in 2 years, like that's a good return. That's absolutely market beating. Like good job. And maybe just to kind of call out two good things that I really liked in the way this conversation was framed. Like solid portfolio, avoiding capital gains tax. So, using the right structures. And that's been like a rocket ship for me over the last 22 years. Like not having capital gains tax on my returns has really, like now compounding is really, really like a steamroller for me. Like that, those tax breaks are very significant. And then the other thing I think is good is this, like this individual said, like, well, quote, I believe I can easily outperform a financial advisor. And that might sound like boastfulness, but actually that is the truth, right? If you manage your own investments and if you're smart, you can beat the market, you can beat financial advisors because their incentives are totally wrong. So these are all really good things. But in the last couple of days, I saw a couple of quotes that made me go, whoa, like this is dangerous stuff. One in particular, so this guy posted, I believe I have a gift for finding the gems. Um, they also posted like some real numbers. Like I'm always talking about percentage allocations and percentage gain. I think just if people who post like real dollar numbers, like, I went from X dollars to Y dollars, that's great. Like, well done. You've now got like a really substantial portfolio. But there's like an element there of like pride comes before fall. Um, and like kind of boastfulness. And it's not that the thing, it's like the achievement is fantastic, well done. But when you're kind of flaunting big numbers like that, that probably says something about, your the way you're feeling like you're just the best. Um, and then the thing that triggered me into saying we should talk about this on the podcast was just a comment over the weekend, I think, where this person was being like challenged by other folk in the community, and they said, "My, I'm good. My plan is to go to cash ahead of a correction and pounce on discounted prices. Like, if investing was that easy, like, none of us would ever suffer drawdowns." And so, let me just sort of make this personal because I don't want to attack this individual. Right, this is how I felt in 2020 and 2021. Like in 2020, I was in kind of COVID stocks and like Zoom and things like that. I did my best annual return of all time, like 90 something percent. I nearly doubled my portfolio. In 2021, I had like a good market beating, but not like crazy, but market beating return. And I look back and I went, I've got enough now. I'm going to quit my day job. And I became essentially a professional investor. Like this is how I now run my life. And then I took, within 6 months of quitting my day job, I took a near like 40% drawdown in my portfolio. And I had got lucky, more than judgment. I think I've said this many times before. Like I did go to cash quite heavily just before the correction, probably more luck than judgment for different reasons. Um, so I didn't take it I didn't get hit as bad as I could have been hit. But if you think you can like time a correction, I don't believe I can time a correction successfully. I think most people would admit to that. If this guy, or if many people think I'm a genius, I can time my way out, I can miss the downside, I've captured the upside. Like this, if this is the first time at some point we're going to hit a bear market, I don't know if it's like tomorrow or in 5 years' time, at some point it's going to happen. If you haven't experienced that, it's going to be like a reckoning and it's going to be painful. And I think it's good to just sort of get your head in that mindset of, I'm not a genius. I've been quite lucky. I've made some good decisions. But, I'm ready for whatever the market can throw at me.
Oh my goodness, so much wisdom coming out of you. Let me back you up and then maybe throw a couple of contrary points badge your way. One, Monkey just spent some time in Greece, and in Greece, that's where the Greeks staged on stage tragedies to help the Athenians see visually for themselves just how badly the gods could fuck with you or the whole city, in ways that are absolutely horrific and that you had no control over in one sense, so that people could be more humble and sort of accept the vagaries of life, as opposed to hide from them, So that's like a thing, right? Go read your Greek tragedies, friend. Seriously, like go read one of them. Go to what's it called, Oedipus, if you need, if you haven't read anything. So that's point one. Hubris, bad. Uh, Two, uh, this one of our laws of the jungle, I think, is there for absolutely good reason. All of them are there for good reason. The If you think you're smarter than the pack, well, it's dangerous to think you're smarter than the pack. I just want to again qualify that's true. I would say what 87% of the time. Where it's not true is where you have committed yourself to studying some industry on a tiny granular level, and you've bought subscriptions to like the digests of whatever field you're looking into, whether it's biotech or the AI computing world or the whatever, and you have literally through professional exposure, you've gained more knowledge and understanding than whatever is floating on the surface of, you know, chitter chatter. And you're making some investment decisions that are contrary because you really do know something that most people don't. And that's, you know, often you see that in the small caps and the maybe even in the mid caps where you can squeeze out alpha from a gap in understanding. But I still think that's a little different than hubris, right? That's I don't think that's you thinking you're better than the market or you're a genius. You've just done work and you know more.
Right.
Um, so that's two. Three, I love the signal you picked up on, like a good poker player, because you're using your poker skills, right, to read people. And you're seeing some of these signs that are like, oh, this isn't exactly somebody merely just managing their money. Now they're posting their real gains. And so, two things about that, right? Because we talked about this ourselves. It's, I think, just basic etiquette in the finance world to not use real money for many reasons, but percentages are actually more signal than noise.
Yeah.
Because in the percentage point, it doesn't matter if you have 1,000 or 10 million, it's the same amount, right? So nobody gets discouraged, and it's right. It's just the more professional way to do it.
Yeah.
So I think you're right to say real money amounts in this case point to hubris. Therefore, this guy's or gal is in danger.
Yeah.
Accepted. What's interesting to me is that you and I talked about this, that there is, because we do the King of the Jungle portfolio and we started with a mere $1,000, mere, I mean, I don't know, for some people that also might be a lot, that some people weren't taking our portfolio seriously because, you know, oh, these guys are only starting with 1,000. And there was a case to be made. Well, what if we posted our real amounts and now we're talking about whatever the real amounts would be, but they're certainly larger than 1,000? Maybe we would be taken more seriously. Like, oh, these guys aren't just monkeying around, though I'm definitely always monkeying around. I'm sorry. It's just I was born this way. You know, listen to your Lady Gaga to understand. um, so I'm a little bit torn about this, and there are some I think people on the X I follow that I think aren't starting from mere hubris, but they're posting larger amounts. So there's a little bit of more credibility there, maybe. But that said, uh, uh, I don't know. It's 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 a little bit of a mix, and I'm left torn. I'm left torn about the. It's kind of maybe I come back to know why you're posting real dollar amounts if that's the route you choose, and all things else being considered equal, be courteous and don't do that. Don't do that.
Yeah, I suppose that's like, and the reason I pointed that out was because as you've identified, like it's an insight into this person's thinking, and it's like the danger, right? And this is the reason we want to talk about this segment on the podcast this week, because to some extent, probably all of us are thinking like we're investing geniuses right now with valuations and like the way stocks have gone. If you're invested in quantum computing stocks, you feel like you're a genius. And I might believe that that's complete garbage. You think like there's a case to be made for investing in them, but regardless, right? You made a shit ton of money even in the last 24 hours on your stocks, right? So you're feeling like a genius. And so, kind of, what's the lesson from times like this? Like, it's when markets are richly valued and high and everything is like buzzing, those are the times to be cautious and be wary and actually do much more work. Like it's almost counterintuitive when valuations are depressed and everything you invest in is losing money because like you're on the way down. In some ways, like they're the easiest times because you try and you find some good quality companies, you buy them, and in some ways you just kind of turn off and just go and do something else with your life, right? And then wait for the cycle to come back, and for those like cheap stuff you bought to hopefully turn around if it's good quality. But when stuff is like right now, when valuations feel like they're not everything is egregious. I think like Palantir and CrowdStrike and Axon, those stocks in my portfolio, I think they are fairly egregiously valued. But I've got other stuff that's reasonably valued, like Alphabet, even though it's like the market's coming to that realization. But it's like those richly valued stocks, they're the ones I'm giving a lot of attention to and looking at almost weekly just to see like what's the trajectory here, what do the valuations look like, should I be trimming? Should I be preparing myself? And I'm always asking myself that question. Like I've got uh, now Rocket Lab all time high in the last one trading day on Friday. Um, I've got it's now the biggest allocation in my portfolio by some margin, even more than cash. And I've got a chunk of cash. I think that's like my portfolio is like 16% Rocket Lab right now. So I'm asking myself the question almost every day: if that halved in value overnight, how would I feel? And like if it's going to impact me, which it probably will, for that to go from like 16% down to an 8% allocation because I just got smashed, well, that probably tells me I should sell some Rocket Lab. And I've made a very structured decision around how I'm going to manage that position because I'm preparing to start trimming it. Yeah, and then maybe trimming is not the right answer, I don't know, but I'm just trying to be thoughtful about it. I'm not coming from the perspective of Rocket Lab's gone sky high. I'm a genius. I cannot be beaten. I'm the greatest investor in the world, because that is going to crush you when the market gives you a slap around the face, which it will at some point.
Yes, Badge, I have an answer for you.
Hmm.
If Rocket Lab fell 50% and you said, "How will I feel?" Uh, you won't feel that great.
Yeah, no, for real. Yeah,
This is
yeah,
my crystal ball. It
yeah.
wouldn't feel that great. But here's the difference between you and our buddy is that you, despite not feeling great, you would not catastrophize and you would not panic sell or whatever the panicky decision might be. And you would actually, in the end, take advantage of the situation by knowing whether it's time or when it's time to add more or whatever the case may be. Somebody coming from the hubris position, they actually might employ catastrophic thinking. And once you cross a certain psychological line, you it's actually pretty dark.
Hmm.
We've been there in different, in different moments and different degrees. You go from being a genius to the complete opposite, saying you know nothing, everything was a hoax, everything is a fraud, you can't trust anything, this investing stuff doesn't work, you drop out, you sell at the low,
Yep,
and you're back to a very bad place financially. So
yep.
that's point one. Point two, Badge, is I think we should devote an upcoming episode to strategies that are, I think of them as insurance strategies. And I've done quite some work over the years learning how to use options as insurance, for example. And so after a certain point, preview, like we have insurance on our house and our car. It's money you expect to go to zero, but having it is a worthwhile investment because the way insurance works, right? So that's for another episode. Let us know maybe in the comments on patreon.com/Wall Street Wildlife what your own experience has been, or experience or strategies managing upcoming potential downsides. How do you negotiate the flip side of the coin? And then we'll maybe make an episode segment out of it in the future.
Good stuff. Great. Yeah. Okay. I think we landed our lesson. And like I say, like we're not saying the market is going to crash. We're not saying you go to cash and you should trim. We're just saying, like, have all of these potential outcomes in mind and try and be balanced with your emotions, not overexcited, because that is going to lead to doom.
Yes. So, Badge, you want Monkey to undo everything we just said?
Go on,
Here we go. So, I have an indecent proposal for you, and you get to make the call.
okay.
This is absurd. This is in the realm of Monkey thinking he's the world's most profound investing genius of all time. But I looked at Monkey's King of the Jungle returns for year two of our contest. So year two started November of 24. So we are what, 2 months away from round trip number two. And sort of disgustingly or preposterously, Monkey's gains for his whole portfolio are 462%
Wow.
uh,
Five bagger on your portfolio.
on the whole portfolio.
Very
So
good.
here's my indecent proposal: will Monkey end the round trip at over 500% because he's an investing genius? or is it gonna end under 500%, or whatever the number might be, and you get to make the over under call, and this would be good for a fine bottle of scotch.
Yeah, I'm down for that bet. I'm down for that bet. Thanks for giving me the option. Um, I am going to wager. I might trade the scotch for a rum. There's a particular bottle of rum I would like. So when I win
Yeah,
this bet,
it goes great with the Negronis. It's
mm,
just the
yeah,
rum based
yeah, yeah,
Negroni. It's just your favorite. Yeah.
yeah. Yeah, I believe in you. That your portfolio is almost entirely EOS. It's almost nothing else. And
I trimmed. I'm trying.
whatever. No, I think you've definitely found something. Like you've found a secular growth trend in energy that I think we're just seeing the early stages of, and like the whole administration, Trump administration right now is focused on energy, and trying to create more of it to keep up with China. So good job with EOS and a whole bunch of your other RECs. So yeah, I think you are going to exceed 500% return, so a six bagger by the by the anniversary, November anniversary.
Oh my God, I'm actually shocked. I'm because I was preparing for you to say obviously the opposite, because I think numerically it's just pretty silly numbers, but I was ready to. Uh, anyway, I'm shocked, but this means that now, in order to win the bet, I have to root against myself. So maybe for the patrons who are on our dolphin trading channels, if all of a sudden you see Monkey making some very shady trades to keep under the 500%,
It's a cheap bottle.
there's
It's a cheap bottle of rum. But don't worry, you maximise your gains, buddy. I think
oh, how can
what you're really asking isn't about your portfolio. What you're really asking me is, are stocks going to go up over the next 2 months or go down over the next 2 months? And like there seem to be a lot of positive catalysts. I think in the short to medium term, I'm certainly structuring my portfolio like I want to be more invested. In the medium to longer term, I probably want to be higher cash. But I'm just not, notwithstanding what we just said about, the red flags we're seeing in some of the investing communities we occupy. We're probably not at the top yet. Again, not a financial advice. Maybe everything collapses tomorrow. Who knows? But it's my feeling.
right? Oh, the irony. I mean, and we do have to go back to an earlier point. Whatever the Fed says on Wednesday,
Mm.
the the I mean, I think if we get the quarter basis point cut, that's sort of what's expected. So the markets are gonna might be a little sell the news, but I don't think it would create too much of a ripple. If we get the half cut, that obviously would be signaling recession, and there we might actually have a significant drop. And who knows how soon it would be bought back up. So I don't know. Choppy waters are certainly potentially in the cards for this week. So let's see how well this ages. Okay, we want to talk about something fairly new to. I don't think we've ever done this before, right? We got
We did once. We did once, but introduce it.
okay. Well, uh, we in conversation with one of our Patreons, he said, would you fellas take a would you mind taking a look at my portfolio and giving it the old stink eye?" And as a little bit of a warning label, one, we are not financial advisors. Two, if we were, we would charge, a pretty penny for this, because this is serious money and people's lives at stake. So it's not something you get advice from, over the internet, so to speak. But we thought this is a really useful exercise, sort of in general, so we could share with our listeners and our patrons the kind of things you may wish to consider when evaluating your portfolio. And maybe if this provides value for people, maybe we'll include another tier on our Patreon site where, in a non financial advice kind of way, we could offer some feedback and provide value that way. But that's in the future. So uh, let's see how this goes. Badge, what do you see when you see this critter's portfolio?
So let me just describe our Patreon's portfolio in outline. So, and there's too much here to show on screen. So right now, I think we're just showing like the top 10 stocks. Um, so
Actually, Badge, let me fill out just one detail, one extra detail. It's like we're looking at a big spreadsheet in which there's 46 positions. So it's a, to me, first glance, when I looked at it, it's like, oh, this is a sort of lengthy, large portfolio.
yeah,
Large in the sense of many
yeah.
things.
And a mature portfolio. So like we've had to read between the lines a little bit with some of the columns, but there's like stocks where our Patreon has bought them like many times. Some things he's bought like 20 times plus, which I can only assume is like, every month payback comes in. Okay, what are my favorite picks this month? So that's actually a pretty good approach. Like dollar cost averaging, I'm assuming that was the approach. Um, and I think, and I also like, this is like a robust, well diversified portfolio that's, it's like somewhat concentrated in that if you look at just his top 10, that's more than half of his total assets. So like most of his money is in a top 10 of high conviction bets. But there's like a long tail. I've kind of structured my own portfolio this way. There's a long tail of another 36 other things that make up like the other half. And there's some interesting ideas in there. And like the portfolio itself resonates with me because I own like many of these stocks, and the ones that I don't own, like you own them. This is actually the portfolio that's very similar to both of ours. So let me just give a quick walkthrough.
Combined, right? Yeah,
Yeah, yeah,
it's like a
precisely. Yeah,
combination with some additional companies neither of us own. But
yeah, yeah. So let's so again, not financial advice. Like if we were really giving financial advice, which we are not regulated to do, you'd fill out all sorts of questionnaires and we'd have conversations about, your risk tolerance and your plans for the future and who your dependents were and how much, what salary and when do you want to retire and all this stuff. Like this is looking at a portfolio in a vacuum and almost saying like, if this was my portfolio, like how would I think about it? That's kind of how I've approached this question. Um, like to start with, I really like the structure of the portfolio and just some of the things that are being tracked. So, like our Patreon is tracking the size of the company, and I did some of my own kind of analytics on that. So, like he's classified like the real kind of mega caps, like the big Nvidias and the Teslas, as being his like extra large stocks. He's got about 23% of his portfolio in those extra large stocks. He's got about 40% of his portfolio in the medium stocks, and he's got about 12% of his portfolio in small caps. That feels pretty reasonable to me. Um, I also like the fact that he's tracking the industry. I think that's a good, simple but a good lens into really properly tracking your diversification. And I do exactly the same thing. Like if you go to, let's say you go to I don't know, finchat.io or any of these websites or Yahoo Finance, right, you can see the segment that a company is in. But often, like, there's only one bucket, and it's often not truly accurate. It doesn't change that often. It may not really reflect like the nature of the business. So what I like to do personally, and what our Patreon I think has done here as well, is they've come up with their own categorization of industry. And like, so our Patreon has identified, you can't see it on the screenshot. He said like Alphabet, Google he's classifying it as an internet company. And if you look online, that like it'd be considered like a advertising company. And in my own structure, I consider it like an AI company. So by kind of bucketing your stocks based on your own way you think about the world, you can identify, are you overexposed? And our Patreon has about 22% of his portfolio in AI stocks, and that excludes Google. So it's probably a little bit higher than that. And he's got about 20% in e-commerce. So you can start to get a feel, where are your biases, and is there some like secular risk that could like hit you if you have a whole ton of money in, let's say, batteries like yourself, and if like suddenly the energy sector falls apart, well, maybe you have like a big risk exposure. So anyway, good structure of the portfolio. And we got a little bit of context as well that our Patreon also has about 7% of his investments in a ticker called VMFXX, which is basically the Vanguard Federal Money Market Fund. So it's essentially like cash, kind of overnight cash. That's a pretty good idea. Like it's a proxy for cash, where you're getting a bit of essentially like an interest rate. And our Patreon tells us that that is about 3 years of expenses. So that is a good, healthy, like position of safety. If the ass falls out of the market, you've got 3 years worth of the bills covered. It's going to help you not panic. So again, I really, really like that approach. Having like, if everything goes to shit, I've still got like, I can pay the bills. I'm not going to have to start panic selling stocks just to like keep the lights on. So that's good structure. I've got a bunch of other stuff, but go on. What do you think?
All right, Badge. Yeah, thank you for that. I want to address the number of positions here. And this is exactly why this can't be financial advice, because wherever Monkey's at in his investing journey is different where our friend is. And so, as one example, if he's retired and needs to conserve capital, that's a whole different ballgame than trying to raise money, uh, to remodel a house in Sicily, for example. So, but because I can't speak for him or her, then then I'll speak for me. One, I'm glad you named the bias inherent in getting our eyes on it, because I'm looking at many of these tickers and I'm like, yes, great job. Yes, yes, brilliant. Oh my God. Oh, wait, I own all of these. So that's a bias, sort of a problem bias. Two, however, is I recently sent out a sort of promotional ish post on X with my own King of the Jungle portfolio. And I structured it so that you could see that I have 18 positions, but I numbered the spreadsheet 1 through 20, with 2 being blank. And that is an exercise in saying to myself, I'm only going to allow my portfolio to get to 20. And then after that, I have to sort of start thinking, okay, what would I need to sell in order to make the next purchase? That's just a frame of mind. But why? Why am I doing it that way? For me, uh, anything past 20 has exceedingly greater diminishing returns, both in time spent following anything more than 20 companies, but also it starts looking like more and more of an index. So in this context, especially because he actually has a large index position, sort of built in, literally with the index, and 46 total positions, I think there's, as a first step, certainly room to cut at least 5. I would probably try to cut 10 to get it down to 30, which would already be larger than what I have, but variance and all the things I can't know. But as an exercise, I know for sure that not all of these 46 for this investor have the same, call it, level of conviction and and excite like future. So he's probably hanging on to a bunch of companies that are there out of legacy or out of I call it a kind of inertia. Well, I already own it, so it's better to not do anything, which in some ways also is the right case. Uh, but I think I would start there. I would actually just go down one row by row and saying, how excited am I about this company in this moment? And just get that intuitive feel and just see where to start potentially cutting or nibbling or doing. Actually, let me take that back. Where I would do more research up front to see if this is a legitimate company to cut. And for one, as one example, not financial advice, but because a Patreon also asked about this company in our investment channel, Datadog, for example, I see as where is it? Number 18, and it's done well. But for my own understanding, this is the kind of company that I'm neither excited about nor do I think is a bad company, but it's just sort of now sort of floating around in the middle. Could that capital be used more effectively in a company that's, say, smaller than $48 billion, but has a much more interesting path ahead of it? And my answer, based on my portfolio, is yes. But you wouldn't get to that conclusion unless you were forced to say, I got to cut something. Like, where do I start? So that's my initial feedback. What do you think?
Yeah, that's not a bad shout. Like, I suppose I spoke up in favor of having the long tail, but you don't want such a long tail that you're just not able to keep track of what your companies are doing. Like, maybe it gets easier if we go to like 6 monthly, not quarterly reporting, but you do want to stay on top of what your companies are doing. And if you've got like 46 positions, it's a lot to stay on top of. But if you do this full time, which I essentially do now, like, it's certainly doable. But you're right, it doesn't harm to just go through and clear out some of the chaff from time to time.
Yes. And follow up thought. I don't know if this was mentioned, Badge. Maybe you could answer, but the amount of I now think of cash as a position. And in my King of the Jungle portfolio at the moment, it's basically zero because I just found too many opportunities to invest in things. So, but a follow up to, let's say, uh, he identifies, to go with my example, Datadog or maybe Trade Desk. Like, these are the ones that I no longer feel particularly excited about. Why not sell those and then actually build up a cash position, start keeping track of that position on here, so that when the inevitable market correction comes, you also have a new position to take advantage of the fall.
I think he sort of does have that because that's the money market fund. But you're right, you could divert sell some of your, just like the stuff that is less interesting, and then turn that into like a bit more optionality by chucking it into your money market fund. Good, yeah, good shout.
Okay.
Yeah,
Do you want me to offer one
Hmm.
more piece of feedback
Yeah.
that's totally different from what I've said? We also heard that he said he'd like to have more chain link, but can't use retirement funds for that easily. And so his chain link position is 0.1%. Obviously, I'm biased because it's my largest position, actually, in the real world, but in King of the Jungle, it's like my number five.
Mhm.
So I'm thinking, yeah, you should have more chain link. But that's not really the point. The point I'm seeing is that this sense of I can't use retirement funds for that easily. I'm wondering what the stuck point is, like what the barrier is exactly to exec to executing that. Do you know?
Yeah. Well, I assume this guy is US based. I don't know how like your 401k accounts work. I mean, I guess you probably can't easily own Link in a 401k.
Okay, so on that level, so the to me, I don't like getting caught by what I would name like artificial barriers. Like if put it this way, let me work backwards. If we knew for sure, because we have a time machine, that Link was going to go up 1,000% by year's end, right? Would you, one way or another, find a way to own more of it now?
Oh, interesting, right? I'm going to push back on this because okay, if we knew it was going to 10 bagger with certainty, obviously yes, you'd sell everything, your house, every
Whoa,
asset, and you'd buy Link, and then you'd
wait, hold on. But no, no, I got you. But let's stay within sort of
right.
the slightly more rational, right? Like
Okay, then
we have
go on.
great odds. We're holding aces, right? We're at the poker table. I'm saying we're trying to get a lot of cash into the pot because the probabilities are good. But we have obstacles, right? Like call it the structure of his plan. I think I'm only saying that, okay, well, but portfolios, you could have two portfolios, you could have three portfolios, and maybe you just open up a side account and you know what I mean? Like,
I do, but you're framing it from your perspective of like this great bullishness in Link, which may or may not be true, right? There's just one man's opinion, and like the whole
sure.
community of Link people that behind you. Uh, right. And if you don't know what Link is, like go check out our episode with Daniel D. Shap, like 50 episodes ago, and that'll tell you what Link's all about. And he's obviously going to be in your camp. But the difference between, well, I don't know about 401ks, but in the UK, like money in SIP, my pension account versus like a general investment account, I have a massive tax advantage in my pension funds. So it so and that amounts to almost, like gains in my pension account are twice as valuable, let's say, as gains in my taxable account. So I have to be, I guess, twice as confident about Link than any other thing. Like it has to be twice as good as the second best idea for me to be putting money into Link, if that makes sense.
Absolutely.
Right.
Yeah.
That's
Yeah,
that's
great.
why it's
Great.
hard.
Yeah, great point. And so maybe this is too obvious a point. I think all I really was trying to say is sometimes we, for whatever reason, and it might not apply in this case, we lock ourselves into what I would call arbitrary uh, hurdles that actually aren't necessarily true if you just step outside of it. You know, you just walk around and say, no, uh, I could open a side account and then problem solved. All other things being equal, so on and so forth. So, but obviously lead with the conviction in the investment. That's primary, and then the structure of the vehicle should be relatively secondary.
Yeah, that's fair. That's fair. Yeah. Yep. Cool. All right. But on the whole, I think this is a great portfolio. I think your advice is good about like just reducing the number of things because it's just easier and it allows you to be a bit more excited about the stuff you own as opposed to having like, the stuff I really love and then a bunch of other shit on the side that I'm not really paying attention to. A couple of other
And
points from me.
it's actually not necessarily just a bunch of shit though, too, because
Yeah,
these
yeah,
are all quality, right?
sure, sure. Yeah.
And sorry, just to make the point finer, it doesn't even have to be end up cutting everything, though I would advise, but not advise that. It would be just getting more clear which companies are floating along like deadwood. That's the main point.
Yeah, that's fair.
Yeah.
That's fair. Yeah, yeah,
Okay.
yeah, yeah. I mean, the stuff you're just not paying enough attention to, like on its own, that's probably a good enough reason to cut it because you're not paying attention to it. Like you can't have an advantage over the market, right? Anyway, so some final observations from me. His biggest positions tend to be ones that he's held for a bit longer, like Mercado Libre. For on average, he's done like 11 buys or net buys, like maybe 12 buys and a sell or something, and he's held it for like over 5 years. So I suppose what that says to me is like he's allowed his portfolio to concentrate itself over time, and that's actually a really good thing. Like you're getting compounding working on your side, and at some point you presumably start sort of trimming stuff because it's got overexposed. But it doesn't have like his biggest exposure is Nvidia at 9.4%. There's probably good reasons that may not be overexposed. Again, it's personal advice. You have to sort of decide your risk tolerance. The only thing I could suggest in terms of an improvement to his process, and I do want to use this to tell you guys again why Fiscal.ai is a superior investing platform. Our Patreon is classifying his stocks by the market they listed in. So, for example, like Nvidia is a US company, Mercado Libre is an Argentinian company, da 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 da. And that is useful in one respect because you know where they're regulated and what rules are going to apply to them, and sort of like their reporting frequency and various other things. But it's less useful for big global companies like Alphabet, like Nvidia, where actually, they're listed in one market. Maybe some of them are like they're listed in bloody Ireland for tax reasons, but actually they're global companies and they generate their revenues everywhere around the world. So I've got quite a lot of value out of looking at that nuance just to see where the money actually, the revenue comes from. If you go to fiscal.ai, and if you want to help us out, go to fiscal.ai/wildlife and sign up with a handsome discount. But even if you use the free version, they have segment reporting. So here's a pretty picture from Nvidia. And I picked Nvidia because it's our Patreon's largest position. But I've done this for like a whole bunch of stocks I own. And they pull like the numbers out of the quarterly reports and they turn it into data that you can use and manipulate. So here's Fiscal.ai's breakdown. And I generated this report myself of its revenue by each of the major geographies. So you can see like the big green chunk is the US revenue. And then like the next biggest chunk is the purpley one, which is Singapore. And then like a bunch, and then like other countries. And because this is data, you can also then like you can construct your own formulae. So here's a graph based on a custom report I created for NVIDIA. And this is simply a simple formula of US revenue divided by total revenue. So we can see, since I'm just showing here January 2020, but you can go way, way, way back. We can see from 2020, NVIDIA was kind of 10% directionally of its revenue from the US, and now it's 50% of its revenue being generated in the US. So that tells you something quite interesting and nuanced about the company. It is clearly a US company. Half its revenues come from the US, but you can see that journey it went on. So yeah, there's a nuance that might improve your process.
Amen and hallelujah. Badge, we are now running on the hour. So, God, we keep having things to say. Can you believe it? But, but I think so. Maybe we push back some of those promised topics from up front to another episode. But we definitely got to hear about your stock safari whoop because I want to know about this thing, and we've been pushing it back for some weeks. So hit us up. What is this new gadget that's turned you into a robot badger, a, a bio biotech badger, Terminator badger? What is this thing?
Yeah, so it's my Safari stock, but it's a private company. You can't buy this in the stock market. They're not a publicly listed company. Let me just tell you quickly like who they are and what they do, and then maybe let's have a conversation about private investing a little bit. We'll keep it tight because you're right. We've had long conversations today already. So this is a Whoop. I've had friends owning them and going on about them for some time, but
Oh,
frankly,
what podcast listeners just missed is that Badger showed this fancy gadget on camera. Another reason you need to watch us on YouTube to get those hours pumping. Look at that fancy thing. It's like a Rolex, but like
it's a
but not.
it's a wristband with no screen. Basically, it's like a sensor that just sits on your arm or maybe like in your bra strap or in your pants or wherever. It's just like touching your body somewhere and then gathering just like a crap ton of telemetry every second on like various things. And they just upgraded the sensor this year, I think in May, and then finally I jumped on it and bought myself one because they had a longevity focus in their kind of Whoop life tier. And that's something I'm focused on myself. I want to live to be like 1,000-year-old badger if I can, because I really want to see compound interest where that gets me. If I can do 22% a year for 1,000 years.
Now we're cooking.
Yeah.
Power
Um,
cushion.
like I'll buy myself a solar system or something. But I like this company so much that I did buy private stock in it. Um, so let's talk about that aspect. I've told you what the thing is, right? It's a I bought in. They didn't have an official funding round, but I had access. So I've been doing crowdfunding in the UK for about a decade or so. And in the UK, anybody can do crowdfunding. You literally go to a website like Angel's Den or Crowdcube or Cedars, and then you could buy, private stock, typically in like really, really tiny companies. Um, and you could buy like £10 worth of stock if you wanted to. But if you're writing slightly bigger checks, then you do get better access to founders. You can meet with like founders and CEOs. And in some cases, like I had the opportunity to like steer the roadmap of companies and like participate as beta testers and things like that. And some of the stuff I'm invested in. Unfortunately, it's harder in the US to be a private investor. And so the US has you have to self-certify irrespective of where you are. So if you're a UK citizen, you can self-certify as a sophisticated investor. And essentially you just tick a few boxes, fill out a form, and you say, like, I am a sophisticated investor, I understand private markets, and you then you're permitted to buy these private stocks. Um, but you give up certain protections that you would have if you were invested in public market stocks. You give up, you acknowledge very clearly that you expect your money to go to zero. It's illiquid. You cannot get your money out. Um, if a company doesn't have a liquidity event, that's it. Your money's tied up. You might be sitting on like 100 times return, but you can't get to that, right? It's trapped until the company like IPOs or gets acquired or, does some other transaction where they start giving money to shareholders. So you could be like destitute living on the street, but you could be like a millionaire and you can't do anything about it, right? You're stuck. In the US, you can't self-certify in that same way. There
Damn it, because Monkey was ready to say, hey, hey, if this isn't a sophisticated investor, then what? What? Come on.
You're very sophisticated. You're very sophisticated. So the rules in the US are a bit different, and I think you still self-certify, but there's like a monetary aspect to it as well. So you could become an accredited investor, and an accredited investor gets you access to certain private deals. And I think directionally, you have to have like $1 million net worth to be an accredited investor or earn over $200,000 a year. Then there are some deals that are a bit more stringent where you have to be something called a qualified purchaser. And that is actually materially a step up. You have to have $5 million in invested assets. So that's like not your house, not like your pension, like in your investment account, 5 million bucks to be a qualified purchaser. And I think that's like the highest tier. That gets you access to kind of pretty much everything. But like I say, so it's more difficult in the US. And I don't recommend this to anybody. I've been quite lucky. Like my very first investment was almost like friends and family round in a UK, a London based tech company. I got introduced to them by a buddy. It's the first private investment I did. And I did it actually because we have some really incredible tax incentive schemes in the UK. One called Enterprise Investment Scheme, EIS, and another one called SEIS, Seed Enterprise Investment Scheme. You get like really serious tax breaks if you're earning like an income, and if you have capital gains from other sources. Actually, for the first couple of years of this scheme, I'm not joking. If you were buying seed enterprise investment scheme qualifying investments, you would get more than 100% tax break. So every like £10,000 you invest, you're getting like something like 10,000 one like £11,000 in tax breaks. So actually, you're getting paid to invest pretty much. Um, so those breaks have been reduced materially, but essentially, like you're getting almost like a 50% tax break today if you have an income, and if you've got tax to offset. So it's pretty advantageous, albeit the stuff is still like if you expect 8 out of 10 of your investments to go to zero. So you're getting a rebate almost on say half of the money you invested, but you're still going to lose money unless what you're looking for are these big multi-bagger returns, which you can get. And I got lucky with my very first investment because these guys got acquired by Snapchat, in fact, and then people in my round all made like a 7x return, like 800% return.
Hey, congrats, Badge.
So that gave me a head start. Yeah.
Yeah. Can so obviously this is advanced like level stuff. All beginner. I don't know if this is fair to say. Like I would not touch this until you've had several years experience because of the great risks. But can I be a little bit simple here and ask you to tell me more about the Whoop thing itself? And the main question I have for you is that I love my Apple Watch mostly. Honestly, it's mostly because I it's just always on my wrist, and so anytime I do, workout, I collect the data, I get the map and all the health stuff. Is the product that you're backing uh, somehow that much better than what the Apple Watch is offering, or what's the? Because that's a major huge now segment of Apple's. Well, I don't know what the percentage is, but it's a big thing, right? So, should I buy one of these things to replace my Apple Watch or coexist with my Apple Watch?
Probably not. I think as like the one thing as an Android committed like Alphabet Google guy that I'm jealous of is the Apple Watch because it's a really incredible bit of technology and it's definitely like it, before like I think they're probably on parity now with the latest Whoop, but that was like leagues ahead. The latest Apple Watch leagues ahead in terms of the sensors and the things it could do than like the nearest Android counterpart. Maybe there were some decent devices from Samsung, but nothing quite had like that design edge from Apple and the fairly sophisticated tracking data. But I didn't want like a watch face on my arm. I wanted something that was like I tried a ring, it just didn't work for me. And I like the idea of a band that was just literally there. I don't have to look at it. It doesn't notify me. Don't do shit. Because I got my phone on me all the time, and I had like a Android watch, being jealous of the Apple Watch for years and years. And I'm like, why have I really got this thing? Because it's just mirroring what my phone's telling me. I just don't need it. But they do some stuff that I think is a bit nicer. So it's like heavily caveated and beta testing. They the latest medical grade. So this version of the Whoop monitors your blood pressure. I don't think Apple Watch does that yet, and they got some proprietary algorithms for how they do that. Um, and it has more of a recovery focus. So if you're a real sports person, you probably have like a Garmin or a Polar or one of those things, and this is like a good complement to that. Like your Whoop is more about like sleep and recovery and like long term behaviors. It's less about like tracking my run and how like the segments and how quick I was, and although it does track that stuff too. But one thing I really liked about Whoop is like this, like I said, this longevity focus. So I get like a report every week that tells me how many years younger than my chronological age I am, and the things I'm doing that are either helping or hurting that.
Well, you're barely like 18.
Yeah,
Just right, you're about to you're fixing to have one of your first drinks at the pub.
when I win that bottle of rum, exactly. Yeah, that'll be my first drink. And the Whoop has encouraged me to drink less. Like that's a behavioural change. It's driven. I never do like strength stuff. I run like every day if I can, and it's encouraged me to get in the gym and actually do a bit of strength work. So it is making like tweaks to my because I'm a healthy guy, but I want to finesse it because I do want to get to 1,000. But one thing they're doing that I don't think Apple have on their roadmap is Whoop have announced that they're planning, they haven't done it yet, to introduce blood tests as well. So you get a lot of information if you take like a blood draw. And I think Whoop are planning to incorporate that under their banner. And then, I don't know how the product will work, but every quarter, you'll send like a blood sample in, and then that'll be wrapped into the whole ecosystem. And there's a really nice kind of AI coach, personalized coach built around all of this data. So that's I think that's actually pretty. It's an interesting model, and it's definitely one that I think the world is going to want more of as increasingly people think about like their health and longevity.
Yeah, that's so cool, man. We could talk about this for a lot longer. Couple quick banana points. One, I'm doing deep dive into Hims, the health platform, and so that too is about upcoming blood testing and lab results. I wonder if there's, I mean, this seems like competition, but maybe not. Maybe there's synergy between just collecting more data and getting blood, whatever. That's cool. I watched the Apple event last week, and the newest watch now has capabilities to measure blood pressure. So if and that I think is like in terms of heart attack awareness or things are not looking good. I think that's one of the first times I've heard like, oh my God, this legitimately could save a huge number of lives. So these kinds of products are interesting to me. I've always wanted to wear my Apple Watch to track fitness. I mean, I'm sorry, sleep health, but I need to charge the damn thing. So and it's my alarm. So I can't wear it. I choose not to. I wonder if this could be, if I'll also get the band biomechanize.
Let me show you something really cool. And I keep taking it on and off because I'm trying to show the thing on the podcast, but I'm charging it right now. Like I haven't taken this thing off since the day I bought it. This is the charger. It's like a little add-on gadget. You charge the battery, the charger separately, and then when you want to charge the gadget, you just kind of mount it. And like between these two things, that's about maybe 20 days battery life. Like the device itself lasts for about 10 to 14 days, and then the battery gives it a full charge. So you got like nearly a month's worth of usage without going anywhere near like a wall outlet.
All right. Thanks for bringing Whoop to the table. Okay, so yeah, we're running long. Here's how I'm going to handle my Safari stock. I promise to actually talk about it, but I'm not going to. If I did make a purchase of this company, I announced it over on our Dolphin channel, Dolphin Trading channel on patreon.com/Wall Street Wildlife. So if you want to do some research yourselves up ahead of me talking about it on this pod, probably next week, then you could find out a big secret mystery. That's not really a mystery, but check out our Dolphin Trading channel there. But I think it's a good purchase, and I like a lot of what I see. I do want to, however, talk about something timely. It's because it's just being talked about quite a lot, which is OpenDoor, ticker symbol OPEN. And Monkey took a position, small, tiny position a couple of weeks ago, and we had a back and forth. Is this preposterous? Is this really investing, or is this just going to the casino? And I think I have a different take here than maybe what you expect. And this comes from a conversation. For full disclosure purposes, Monkey and Mr. Tinker actually had some live in person. I'm sorry, we talked over the phone some years back when we were doing massive EOS due diligence. So I know Mr. Tinker more than I might know a complete stranger on the interwebs. Here's the conversation. So I'll read this out loud and then comment on it. Mr. Noble says, "Want to speculate? Be my guest, but let's not pretend that there is a fundamental case for OpenDoor. The numbers have never worked and will never work. End of story." To which Mr. Tinker says, "Numbers have not worked in the past, but what tells you they won't work in the future? Have you seen all iterations of the new business model and how they will impact economics of the business? I haven't. A lot of things have changed in terms of technology and market structure since Open 1.0 has been created. On top of that, Open is again founder style led, lots of levers that can be pulled. Mr. Noble replies, "No. Instead, you don't understand basic finance." To which Mr. Tinker says, "I may not understand basic finance, but I am fluent at advanced finance." That was part one of the conversation. Mr. Tinker is, in fact, a very sophisticated investor. So this isn't a case where you have one noob or memeish cult member talking to, a professional. Here's what I see in this conversation. This is the main point. you have two, call it intelligent and smart investors that really are sophisticated in terms of spreadsheets and numbers and running lots of money. And one is saying basically you're an idiot, you don't understand finance, and the other saying no, I'm looking at this in a very, very different way than you. And I think my what I want to come across is that it's not one of these guys is going to be right. And maybe it's the guy that's sort of fundamentalist driven. Maybe it's the guy that's saying, Mr. Tinker saying, market is not backwards looking, it's forward looking, and there's all kinds of new things happening. But it's this thing that humans tend to do, which is arrive at a fixed viewpoint and then not allow the possibility that something is not exactly how they see it. And this is especially, I think, the people that are guilty of this are those that are exceptionally good with numbers in one way in their spreadsheet. They put in their numbers in the spreadsheet and they sort of lock themselves into thinking this is the objective absolute truth. Now, if investing was as simple as doing, call it basic math, and not even basic math or sophisticated math, then there'd be no room for, call it, the unexpected things and the subjective things and the God only knows, the call it emergent things that complex systems reveal. And so there'd be no, the market would be efficient. And that's what basically the first guy is arguing. The market is efficient. There's no way in hell this is ever going to turn into anything. And sure, he might be right. I mean, of course he might be right. But I took a position in this more for Mr. Tinker's reason that there was enough substantial, fundamental things that intrigued me. And some of that did have to do with the, call it, uh, sea change in management, sea change in going from a dead company that was doing more of the same to, oh, we have something legit here, and if we could reorient ourselves or reorient the model, then we've already done massive work on the, call it, data platform level. This could be a whole new thing, and I was okay making this an actual investment in King of the Jungle because I don't fully know which way it's gonna go. I size my bet properly, and I'm open. I'm open. I remain open to uh, whatever the thing grows into. I'm not. You would never see me saying you don't know basic finance to somebody who, ironically, obviously, to beat the dead horse, is a very sophisticated investor himself.
Oh, it's easy to argue with people online, right? I get baited into it sometimes, and I usually reflect and go, "Oh, I shouldn't have gone there. I should just take the high road."
Yeah, and so I'll end this this. I hope it doesn't come across as a tirade. Mr. Noble again says, but we do understand that Open has lost money every year, is valued, at 22 EV revenues, and is just continuing to list the sort of, like, I would um, call it fundamental metrics. And Mr. Tinker replies that, that the probability is not about flipping houses. It's about owning the transaction rails of US housing, meaning that this is a pivot, and that they have enough to make the pivot a non-zero or whatever probability, so that this guy, it's kind of, it's like two people arguing past each other. And it there's no reason for that, right? I think both guys could sort of learn from one another and acknowledge that there's both sort of sides have something worth paying attention to, but don't dismiss the whole, but make this into a black and white case. It's quite mixed. And by the way, monkey's up like 120% on the trade. So in the end, I could be the monkey that just gets his bananas, pockets them, let the pros argue out. It could be as simple as that. Whatever.
No, that doesn't turn into hubris. Yeah,
Exactly.
yeah, yeah. All right, very good. Hey, before we wrap, I just want to give a shout out to a fatal error I may have made. So last week we had Musk. We talked about Musk's compensation package. I was like, yeah, this is great. Like, he's got these soft provisions around not getting involved in political antics. And then over the weekend, he like live streams into some like far right demonstration in London, and I'm going to give credit to Ben at the Seven Investing Discord for this one, but I thought it was very funny. Musk inciting civil war in the UK brings a new meaning to the term wartime CEO.
Oh man. And also I think he just bought like $1 billion of stock. Uh so I mean, the Musk soap opera uh rumbles on. God only, fascinating. Anyway, all right, Badge.
Well, if you want to be part of the Wall Street wildlife soap opera, we have something quite exciting coming up. So I think we're right now recording episode 98. Episode 100 is going to be a Patreon exclusive live stream. So if you want to be part of the live stream conversation, we're going to have some of our jungle beasties joining us on the pod, firing in their questions, their challenges, their memes, and their nonsense. Maybe we'll have a drink together, and then we'll be heavily redacting the nonsense that happens in the live episode 100, and that's going to go out as the official episode 100. So if you want to be part of or see the real episode 100, then go sign up at patreon.com/Wall Street Wildlife and become part of the team.
Right. And if you're a regular listener, please take a look at the poll, our scheduling poll, because we're trying to make it as easy for as many of you to join us. And I believe right now there's a Friday and a Sunday date that are winning. And I think they're tied. So please vote if you can. We'd love to do the community thing and get to see some of your furry faces on the live stream.
Great stuff. Are you ready to become a beast of an investor?
500% portfolio returns. Here we come. Arrgh.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.